Have you ever wondered why the money in your pocket today may not be worth as much as it was a few years ago? In this video, we'll explore the concept of how money loses its value over time. Money is an essential part of our lives. It helps us to buy goods and services that we need to survive, and it's also a symbol of our economic well-being. We use money to invest, to save, and to spend on things that we enjoy. However, the value of money is not constant, and it can change over time due to various economic factors. In this video, we'll take a closer look at how money loses its value and what we can do to protect ourselves from its effects. 1. Inflation. One of the primary ways in which money loses its value is through inflation. Inflation is a sustained increase in the general price level of goods and services in an economy over time. When the price of goods and services increases, the purchasing power of money decreases. Inflation can occur due to various factors such as an increase in the money supply, rising demand for goods and services, or a decrease in the supply of goods and services. Inflation affects everyone, but it has a more significant impact on people with fixed incomes, such as retirees. Inflation erodes the value of their savings, which means they have to spend more money to maintain the same standard of living. This is why it's essential to invest in assets that can keep up with inflation, such as stocks, real estate, or commodities. 2. Currency devaluation. Another way in which money loses its value is through currency devaluation. Currency devaluation occurs when the value of a currency falls in relation to other currencies. This can happen due to various factors such as a decrease in exports, a rise in imports, or a decrease in interest rates. When a currency is devalued, the cost of imports increases, leading to higher prices for goods and services. This, in turn, reduces the purchasing power of money. A devalued currency can also lead to a decrease in foreign investment, which can hurt the economy. To protect themselves from currency devaluation, some people invest in assets denominated in foreign currencies or buy gold and other precious metals. 3. Economic recession. During an economic recession, the overall demand for goods and services decreases, leading to a decrease in prices. As prices fall, the purchasing power of money increases. However, during a recession, unemployment rates are usually high, and people's incomes decrease, which can offset the gains in purchasing power. Recessions can also lead to a decrease in consumer confidence, which can lead to lower spending and slower economic growth. To protect themselves from the effects of a recession, some people invest in recession-resistant industries such as healthcare or utilities. 4. National debt. When a country has a large national debt, it can lead to a decrease in the value of its currency. This is because investors may lose confidence in the country's ability to repay its debt, leading to a decrease in demand for the currency. A decrease in demand for a currency can lead to a decrease in its value, which reduces the purchasing power of money. Countries with high levels of national debt may need to implement austerity measures to reduce their debt levels, which can lead to slower economic growth. 5. Technological advances. Technological advances can also impact the value of money. As technology improves, it becomes cheaper to produce goods and services, which can lead to lower prices. This, in turn, can increase the purchasing power of money. However, technological advances can also lead to job losses, which can hurt the economy and decrease the purchasing power of money. It's essential to recognize that money is not a static entity. Its value is subject to a wide range of factors, and understanding these factors is key to protecting our financial future. One of the primary factors that affect the value of money is inflation. Inflation occurs when the general price level of goods and services in an economy rises over time. This leads to a decrease in the purchasing power of money, which can erode the value of our savings and investments. Understanding the nature and causes of inflation can help us to plan our investments and savings strategies accordingly. Another factor that can impact the value of money is currency devaluation. This occurs when the value of a currency falls relative to other currencies. A devalued currency can lead to higher prices for goods and services, reducing the purchasing power of money. Understanding the causes and consequences of currency devaluation can help us to protect ourselves from its effects by investing in assets denominated in other currencies or buying precious metals like gold. Economic recessions can also have a significant impact on the value of money. During a recession, demand for goods and services typically decreases, leading to a decrease in prices. This can increase the purchasing power of money in the short term, but it can also lead to job losses and a decrease in economic growth. Understanding the nature and causes of economic recessions can help us to make informed decisions about our investments and saving strategies. National debt is another factor that can impact the value of money. High levels of national debt can lead to a decrease in the value of a country's currency, as investors may lose confidence in its ability to repay its debt. This can lead to a decrease in the purchasing power of money, making it important to pay attention to government debt levels when planning our financial future. Finally, technological advances can also impact the value of money. As technology improves, it becomes cheaper to produce goods and services, which can lead to lower prices and increased purchasing power. However, technological advances can also lead to job losses, which can have a negative impact on the economy and decrease the value of money. In summary, understanding the factors that impact the value of money is crucial to protecting our financial future. By staying informed and taking steps to diversify our investments and saving strategies, we can better protect ourselves from the effects of inflation, currency devaluation, economic recessions, national debt, and technological advances. It's important to have a long-term investment strategy, avoid making emotional decisions, and stay informed about economic trends and events to ensure that we are best positioned to achieve our financial goals.